All right, I think let's get started. Hi, everyone. Thanks for joining in today on this session. Obviously, market's been having a whiplash over the last 1 week or so since the Liberation Day on April 2nd. And I'm sure all of you have been going through quite a turmoil in terms of your investments and all as well. So we did a webinar last week, and I thought, given what's happening in the markets, it's important that we keep you posted in terms of what's been happening in the markets, how investors are reacting to it, how you could position yourself, and what's the outlook kind of like going forward. So I'll start off with a few, context in a few slides. We'll keep it to 15-20 minutes, and we'll open it up to Q&A because I really want to see, what you guys are doing, thinking, what your questions are, and we'll try to address as many of them as possible today. So stay tuned. We are continuing on this roller coaster ride, but hopefully, things and saner minds will prevail, and hopefully things will become better as we move forward. So let's move on to the next slide. Let's quickly cover a few things. So most of you know me. Let's move ahead. So today, as I said, right, we'll just quickly cover what the tariff-induced sell-off has been, putting into perspective what led to the market reaction, how severe it is historically, and what does it mean for you as investors. And then I'll open it up to Q&A. So let's go directly into the next slide. Obviously, next one, please. All right. So obviously, it started off with the Liberation Day, right? And with Trump announcing reciprocal tariffs. And the kind of tariffs that he mentioned in terms of what other countries are imposing on the US ranged from, 10-20% all the way to 100+%. So these were the tariffs that Trump was saying that other countries impose on the US. And because this has led to wide trade deficits, it's only natural for the US to reciprocate on those tariffs. And him being generous said that I will put 50% of what you charge to me, I'll charge 50% of that to you. And I'm being generous here in terms of giving you that discount. So the reciprocal tariffs set in motion. He had a big chart which looked something like this. And as you can see, someone like China, which Trump said imposes 67% tariffs on the US, you impose 34% tariffs on them. Similarly, all the other countries go, from 10% as a base. So any country, whether you have a trade surplus or deficit, whatever, they get a 10% tariff. But if you have, higher tariffs for the US, then you get, higher tariffed, higher 50% tariffs, 50% of that tariff onto your country as well. The only problem with this was the fact that the actual tariffs that these nations charge on US goods is actually not even close to these numbers. So the way the calculation for this tariffs was done was not based on the actual tariff rate that these countries actually charge, but it was done based on the trade deficit that the US has with each one of these countries. So the larger the trade deficit, basically, the larger the reciprocal tariff that the US is, now going to propose and put on you. Now, how did this come into, being as well? I think it goes back, it's a, interesting story. So the tariff plan came into motion because, Trump has this economic advisor called Navarro, and he's been a China hawk for many years. This particular person was part of Trump's first administration as well, and now in the second administration too. The story goes that basically, he is a Harvard-educated economist, and he wrote in 2011 a book called Death by China. And that kind of, encapsulated the point that essentially how China is, doing really bad things in terms of imposing tariffs and, the cheap sort of manufacturing goods, dumping them into the US, and that will change the global order eventually. And he interestingly cited another economic expert called Ron Navar, or Ron Vara as the expert who, he reversed, and because of him, he actually, came up with this whole tariff structures, etc. and all. The only problem is, this expert Ron Vara doesn't exist. It's actually his own name in an anagram format. So he is like his alter ego of sorts. So essentially, what does that all mean, right? Like, Trump has basically hired this economic advisor, and he's been a China hawk, and he, himself basically been advocating huge tariffs as a way to reduce trade deficits on countries. So now in the second administration, as Trump was thinking through what to do in terms of reducing the trade deficit, the formula that they came up with was basically the trade deficit divided by the import. So that is the kind of formula that goes into the calculation of these tariffs. And what that means is, even if your actual tariff rate is like 5%, but the fact that you run a surplus with the US, you will be tariffed reciprocally on your goods sent to the US as well. So essentially, this came into effect on April 2nd. And obviously, if you go on to the next slide, this is historically, if you look at it, the highest tariffs in more than 100 years. So this level of tariffs have never been imposed for the past 100 years. It has been, again, projected as reciprocal tariffs, but there is actually nothing reciprocal about it. It is purely meant to reduce the trade deficit that the US runs with other countries, right? And at 20%, it's a historic 100-year historic high, which obviously has far wider implications, because maybe it will help in the US government collecting more revenues, but the tariff impact goes beyond just that, because it also impacts your consumption and ultimately your GDP growth, etc. and all. And there has been wide calling that essentially this will lead to a recession going forward. If you move on to the next slide, more importantly, there is obviously a much bigger focus on US versus China, and there is an escalation amongst all the countries. Most of the countries have said that we want to negotiate with the US and figure out what's the best way to make these tariffs go to a more reasonable level. Now, certain countries have even proposed that we will reduce your tariffs to zero. I mean, the reality is the actual tariffs imposed by these countries only like 5% or something. So even if they reduce it to zero, the reality is the trade deficit will not go. And because of that, the US basically said that that's not enough, and the tariffs will continue. But specifically on China, I think amongst all the countries around the world, China is the only country that stood up against the US and said that, okay, if you impose tariffs on us, we are gonna, retaliate and put tariffs on you as well. So you saw that the US tariffs came into place on 2nd April at 54%, and China swiftly responded with 34% tariffs on the US. And now it is basically escalating, right? Like the US has further increased it to 104 and now 125 just yesterday. And the current China tariffs on US has thus increased to 84% as well. So the question is, who will blink first? I mean, obviously, this helps no one. It doesn't help the US. It doesn't help help China as well. But amongst all the countries, the only country that can actually stand up against the US is China. And while in the short term, I do think China will have a potentially big impact in their GDP growth as well. And China has already revised their GDP growth numbers from like 5% to, or more than 5% to 5%. If these tariffs hold and not negotiated away, you're looking at China's GDP growth to go, below 4%. So that obviously will have profound impacts on China. But I think if you look at China as well, they are also trying to move from an export-oriented economy to a more domestic consumption-led economy. Obviously, again, that will not pan out very, very soon. But what it means is in the near term, you're looking at huge policy stimulus coming in from China. And that in the short term can again even out some of these pressures from tariffs that we are seeing as well. But not just the China side of thing, on the US side as well, we are seeing huge implications if this tariff holds. And the markets kind of like said that, right? Like if you go on to the next slide, you see the market turmoil, and I'm sure all of you have, gone through it. Everything is red. So the 1 week return across asset classes, and there is no safe haven as well. Like, even gold down 5% over here. crude down 18%, and our local Straits Times Index down 13%, but also S&P 500 and Nasdaq Composite down double digit. And all of these indices, major indices, Nasdaq is already in correction territory. I mean, in bear market territory. So last time when we did the webinar, most of these indices were in correction territory, meaning that they were down 10% from their recent peak. Now, Nasdaq and the small cap index in the US, they are in bear market territory, which basically means that they are down by more than 20%, right? You see over here, year to date, Nasdaq Composite down 20%, right? So obviously, this has led to a huge amount of panic. You saw the markets go down to levels that you have not seen for a very, very long while. The S&P 500, for example, dropped 11% in just 2 days. And this is basically the fifth largest 2-day drop in S&P 500 since the Great Depression. So you can really see that the market is like pricing in, a much worse outcome, and they are believing that recession will actually take hold. But let's move on to the next slide. It's not as simple as that, because if you look at the US Treasury on the other side, I think from a Trump perspective and the, administration perspective, they had a game plan. And it was kind of like a perfect game plan that, okay, we will put the tariffs. It will lead to a little bit of market meltdown, but it will lead to Treasury yields going down. And why will Treasury yields go down? Because if markets are going down, if economic growth is impacted, then in a way you're engineering kind of like a soft recession. And if there is a recession, the Fed will cut rates, right? And if the Fed is cutting rates, then the yields should go down. The only problem is the yields actually didn't go down. As you can see over here, the yields have shot up. And this is where, alongside the market going down, you're seeing that the yields, the Treasury yields, which were supposed to go down as well, they didn't go down, they're moving up. So now, I mean, obviously, within the Trump administration and his supporters as well, the panic grew to, more tremendous level, in my opinion. If you go on to the next slide, you see what Trump supporters have been saying and what, some of the experts have been saying as well in response to these tariffs. Start off with Elon Musk, because obviously, he's been embroiled into this in much deeper way than anyone could have imagined. And Tesla stock is down more than 40-50% year to date. Obviously related to Doge on one hand, but Elon Musk being so involved in the political situation in the US has also had an impact on his personal net worth, on Tesla stock, and more broadly tariffs as well, right? It impacts him very badly because he's got business around the world. And he was relentless. He has been again supportive of Trump and been part of the administration to a certain extent. But the economic advisor Navarro, he had a fallout because he said that, okay, we need to look at this a little bit more holistically and think through what the implications of these tariffs and all are. And Navarro said Elon Musk is just a car assembler, right? So it led to a tit for tat, and essentially Elon Musk used terms like this guy is dumber than a sack of bricks, and then later he apologized to the bricks actually. So very funny, but obviously you can see the pain that he's going through. But also if you look at Jamie Dimon, he's saying, I think probably there is a recession. It's a likely outcome. The quicker the issue is resolved, the better. And he actually warned that if so there will be difficult to reverse negative impacts compounding with time. So the longer this tariffs remain in place, the negative impact will keep compounding and it will be difficult to avoid a recession. So this is also a reason why I believe Trump has actually blinked, and this 90-day reprieve that we'll talk about is more led by all of these negative impacts starting to kick in, and the actual outcomes that they had sought did not actually materialize. Similarly, Bill Ackman, again, supporter of Trump, don't think this was foreseeable. I assumed economic rationality will be paramount. If the president doesn't pause the effect of the tariff soon, many small businesses will go bankrupt. right? Ray Dalio, again, like, he's talking of a different context altogether. He's talking about, it's not just about the tariffs, it's actually, the whole global order is changing. And it is this, time where we are seeing the rise of China. And it's a once in a lifetime breakdown of the global monetary, political, and geopolitical orders as well, right? And he's basically very concerned about the practicalities of the Trump tariffs. And once the tariff, actually this 90-day reprieve has come in, he's basically saying Trump's decision to step back from a worse way and negotiate how to deal with these imbalances is actually a much better way, right? So if you go on to the next slide, you see that the markets actually behaved what they did yesterday night, right? Now, as soon as there was this 90-day reprieve, the markets bounced back massively, and I believe that markets always overshoot. They overshoot on the downside and they overshoot, or in my opinion, they've overshot on the upside yesterday as well. And you can see that the futures, S&P 500, giving up a little bit of the gains right now. But what you can observe over here is S&P 500, it posted the third largest one-day jump since 1948. It's 9.5% within a day. Can you imagine that, right? And this again, like, goes back to, things that we have been advocating for a very, very long time. And like, even in the last webinar and seminar, I was talking about this, that why remaining invested is very, very important and not to panic is very, very important. So if you go on to the next slide, good days do happen in bad markets. If you, again, like, concentrate on this left chart, I had shown this in last week as well. 50% of good days or the best days in the market actually happened during a bear market. So we were in a bear market last 1 week. And the 9.5%, jump that you see or you saw yesterday night is basically the third largest jump in more than 50, 70 years, right? So this thing about 50% best days, happened during a bear market very much, came into being. And if you were out of the market or you sold off during the market downturn, this is where your returns get significantly smashed down, because, like, if you see on the right-hand side, missing the market's best days has been really, really costly. 9.5%, not easy to make up if you missed that out yesterday night, right? And you can see that if you miss 10 of these best days, your returns versus if you remain fully invested goes down by more than 50%, right? So, it's super, super important. And, again, we will run a poll and try to understand how you guys have been, managing your money so far. But this is a very, very important chart. And this is, kind of, again, a reminder why, we should not be panicking when the markets are going through what they went through. But rather we should look at our portfolios. We should look at, how we are investing, how well we are diversified, and use these as opportunities. And we talked about, like, enhanced dollar cost averaging the last week as well. We will potentially go through that again, do a refresher. If you have questions specifically, we'll address them as well. If you go down to the next slide, just quickly covering a couple more points there. Can we go to the next slide, please? Okay. So again, while there are drawdowns, there are multiple, years where you see intra-year calendar declines, but on average, you see the average returns of S&P 500 has been positive most of the years, right? And it always kind of like bounces back. And over the past 20 years, the S&P 500 has seen an average intra-year correction of 15%, 14.5%. So it's not new. This actually happens very frequently. In fact, a 10% correction happens every 2 odd years, right? And a 20% correction happens every say 5 years or so. So these are not things that never happen. It do happen, but if you remain invested through these ups and downs, if you go on to the next slide, you see the long term. Okay. Before that, I think again this one very important. If you see, when there is a market correction and you look at the returns of S&P 500 12 months after hitting the correction territory, which is like 10% down, in 9 out of 10 cases, the return's actually positive, and it's double-digit positive, right? So it just goes to show you that you should really use all of these opportunities to your advantage rather than panicking and selling. If you are a long-term investor, you should, number one, remain invested. Number two, diversify. But number three, add and dollar cost average as well. If you go on to the next slide. So this just captures like how on the long term, very long term, if you remain invested, a $1 invested in 1970 becomes $137. That's 137x of your money that you've been able to do through this period. And you have gone through multiple crisis situations, right? Like, you've gone through the financial crisis, you've gone through COVID, you've gone through, the 2022 interest rate hiking cycle, Black Monday 2000, all of those different crisis situations where each time you thought the world's going to come to an end. But if you remain invested, you see how your returns keeps compounding over time. So with that, I will take a pause and I'll really open it up to questions, because I think it's important to hear from you guys how you have been investing and what your questions are. Okay, before that, I think there's a poll. How much is your investment portfolio down this year? Oh, wow, 33% saying they're up. Very interesting. I think there are very less number of participants here. So please join in on the QR code and put down your votes, please. Okay. So few in cash. All right. I'll just let it go till maybe like 20 to 30 people have voted. I think it'll help in terms of actually understanding how painful this has been for most of the investors. Okay. Okay, we are at 26, so 30 participants. Okay, so we are seeing the trend now, right? Essentially, you can see that only 7% are actually up, but there's like 35% who are down 10%. There are 37, close to 40%, which are down 10 to 20%. And there is another 12% who are down more than 20% as well. So obviously not an easy ride, right? Like, so people who are up now down to 5%. So, and I'm sure like, people who are up are not massively up, like, you're barely managing, in my opinion. But again, I can feel the pain, and that's why we'll open up to questions in terms of, what we could do as we move forward. Next question, please. Okay, yes. So what's your plan from here? Okay, so 40 participants. It's actually really good to see most of you are buying the dip as well as staying invested, and very few and selling to cut losses. Interesting to see that very few are staying in cash as well. I thought usually, I've seen people with a lot of, cash on the side. All right. No, this is great. This is great. Thank you, guys. Thanks for voting. Let's go on to the Q&A then. Okay, great question. Why are Syfe income portfolios also impacted, although they are bond funds? So I covered this a little bit previously where, sorry, 1 minute, where US Treasury yields have started to move up, even though they were supposed to come down, right? Like, when there is, market sell-off, you expect the bond market to be your friend. And when equities are selling off, you basically have inverse correlation, and the bond market becomes your kind of like safe haven and all. Now, when it comes to bond investing and specifically income portfolio investing, there are two things at play. The first is basically your interest rate, how that moves impacts your bond prices. So if interest rates go up, bond prices go down, right? And in this case, interest rates were supposed to come down, so bond prices should have gone up, but actually interest rate started to move up. And that's why bond prices started to contract a bit. It did not impact so much on that side for the Syfe income portfolios because, we are not longer dated. We are not holding longer dated bonds in our income portfolio. So the longer the maturity of your bond, the greater the impact of the interest rate movement. So if the interest rate movement is, what happened, as you saw with the US Treasury, if you have shorter duration bonds, the impact of that interest rate movement will be much lesser. So our duration of our portfolio on the income side is 4 to 5 years. And that's why the impact of the interest rate movement, which went against, what the anticipation was also kind of like 50% of what it should have been. So yes, it came down on the interest rate side. This was the reason. The second thing that influences, our bond portfolio is credit spread. Now, because of what the tariffs could mean to different companies, etc., it can impact their credit worthiness and their ability to repay their debt in the long term and all as well. So that led to the credit spread widening, right? And again, when credit spreads widen, then your bond prices come off, right? So you had this double impact of, slightly being impacted on the interest rate side, but also, getting impacted on the credit spread side. Now, again, on the credit spread as well, when you look at the Syfe income portfolios, the average credit rating of our bonds is A or A minus, which means they are very high quality bonds. And that's why the combined effect of both of these, which went against what was anticipated, the combined effect was negative for our bond portfolio and the income portfolio, but it was not as, negative as it could have been for a high yielding kind of income portfolio, right? So yes, the Syfe income portfolio did come off slightly, but the good news is, number one, it is still insulated a lot by the structure of the interest rate being less of a dominant impact because the duration is low, and the credit quality being super high. So the credit spreads widening also did not have that much of an impact, right? So, and again, like going forward as well, you will see this kind of continuing. And the fact that the yields and the coupons of the bonds are still very high. So even though you are suffering a little bit from a price move standpoint, the overall return should be okay as we head into the second half of the year and all, because you have that cushion from the high coupons and the dividend yields from these bond portfolios as well. So I believe you're, in the right place if you're invested in the income portfolios and you, want to keep your, sort of investments more or less stable. And at the same time, you want to, generate these dividend yields on a consistent basis and use this as an income generation strategy. I think you're still very, very okay with our income portfolios. Slight impact because of, what I just described. But, overall, they should be okay as we move forward as well. Okay, next question, please. Is this a good time to buy the dip, or are we expecting further declines? Look, I think short term, this was kind of like a relief rally of sorts. Long term, there is still a lot of uncertainty, or near term, there is still a lot of uncertainty, because we've got a 90-day reprieve from these tariffs, but there is still a 10% baseline tariff that still applies. There is still, some tariffs on, Mexico and Canada, and obviously there is this escalating trade war between US and China as well. So I don't think, we should be saying that this was the bottom of the market. It can be the bottom in the near term, but in terms of whether there can be further declines, yes, there can be further declines. Does that mean you should, hold on and not do the buy right now? I don't think so as well. I mean, we again went through this last time as well. Each 5 to 10% drop is an opportunity to buy. If you want to do it systematically, just continue your dollar cost averaging. Don't look at the market on a day-to-day basis, because, you will not be able to time. Like, what happened yesterday just happened within half an hour, right? Like, the whole trend reversed. So if you are trying to speculate where the market is going, I don't think, you will end up in a very good state in that way. So keep that discipline going when it comes to dollar cost averaging. I will, remain invested in equities. I'm an equity investor. I am, investing for growth. And if you're investing for growth, there is no better place than equities, right? And each 5%, each 10%, drop in the equity market. And now, I mean, as I said earlier, we are looking at a 20% drop. 20% drop doesn't happen that often, right? Like, I said, it happens maybe once in 3 to 5 years, right? And can there be another 20% drop if, China, US trade escalates, if there is an actual recession, the earnings is just kicking in. So that's another thing to look at. You have the bank earnings starting to kick off, and then you will have the tech earnings, etc., coming in the next couple of weeks as well. And while I do believe that maybe the earnings themselves will hold on, but the guidance that most of these companies will provide will obviously be a much more muted. And if they're going to be muted, that will have impact on, again, the earnings growth potential of these companies going forward. And if earnings growth comes off, the valuation at which these companies are trading will not stay at that level as well, right? So there are still a lot of unknowns, a lot of uncertainties. But do I know if this is the bottom? I don't know. Am I buying through this dip? I'm definitely buying. Am I buying full-fledged? I'm like, if I've got $100, am I deploying the whole $100 into the market? No, I'm not. I'm putting it in tranches, meaning that, if you've got $100, maybe you can put a tranche of $30 to $40 now, right? If there is another dip, you still have some dry powder left, right? This is obviously a little bit more active, but if you don't want to look at the market on a day-to-day basis, actually, that is the best thing to do. You should not be looking at the market on the day-to-day basis. Just automate your investment. We have some great features in the Syfe app where you can basically, do a recurring transfer. And you can set most of your money into our cash plus portfolio, where you anyways start earning yield on a regular basis. On SGD, you are earning 3.1, 3.2%. On USD, you earn, 4.3% projected, I think. And while your money still generates that income or yield, you configure a dollar cost averaging into the equity, markets, whether it is, through our equity 100 portfolio, which is our flagship strategy. And I can share how that portfolio has done over, the course of this period and all as well as, some of our other portfolios too. So maybe I'll show, that before I take on the next question. And if you guys have specific questions on our portfolios as well, we can go through them too. So if you can switch back to the slides, and I just quickly want to cover how our portfolios did through this turmoil. Okay, I think before that, I was talking about this as well, what to look ahead. The retaliatory tariffs are in from the Chinese. There is another, policy meeting and, administration meeting in China happening today. Through April to May, now that there is a thaw and this 90-day reprieve, you will see a lot of trade negotiations between different countries and the US. And obviously the earnings announcements are coming in. 5th and 6th May, FOMC meeting, right? This is the other big thing. The markets are now expecting 3 rate cuts. We were at 1 rate cut starting the year. Then it grew to 2 rate cuts, now 3 rate cuts. It went all the way to 4 rate cuts anticipated. But I do believe, in the May meeting, we actually might see a rate cut coming through. And then there is obviously the inflation data, etc., coming in later in May as well. Okay, let's quickly cover the Syfe portfolios, please. All right, so if you look at the managed portfolios, and especially, the equity 100 and the downside protected portfolios, right? We had introduced these downside protected portfolios, and actually, I think the timing was, again, great, because this is a portfolio that held and did the way it was supposed to. Now, we have, in this portfolio, what is called as a downside buffer level, beyond which, it should not drop below that level, even if the S&P and, other indices drop massively. And that's exactly what happened. The S&P did drop from peak profit, dropped by 20%. And the downside protected portfolio, it slightly went below the threshold. I think the threshold was 2 to 3% downside. And it was like 3.2% down, right? But now it's also recovered and definitely held on to that threshold of the downside protection that we had put in place. So again, people who are wary of where the markets are going but didn't want to miss on the upside, this portfolio has done tremendously well, in my opinion, and held its value. And this is, again, someone who is a more active investor. If you're invested in the downside protected portfolio and you didn't see these drawdowns in your investments, this is actually a great time for you to, again, then deploy it into the equity portfolio when you actually see the market actually going down by 20%, right? So that could be one strategy. But even the equity 100 strategy, you can see in terms of the drawdown, much lesser drawdown compared to your S&P 500 and the Max 7 stocks, and recovering in the same breath as these are recovering as well. But obviously, as we move forward, you will continue to see much more volatility within S&P 500, within Mag 7. Mag 7, given, again, the premium valuations and potential of, the guidance coming in weak as we move forward, and S&P 500 because it's actually dominated 30+% by these Mag 7 companies as well. Versus our equity 100 portfolio does have the US exposure, so you see some correlation there, but it also has a global diversification kind of like built in, because of which, it avoids the kind of capitulation that we were, almost witnessing in the markets the last few days. All right. Let's quickly cover income portfolios. So you see, right, like, as someone was pointing out, like, why is Syfe income portfolios going down? Yes, slightly went down, but again, nothing in comparison to the, equity markets, which went down 20+%. We did say month to date, 1 to 2% drawdown in our income portfolios, but they're still positive on a quarterly basis and on a year-to-date basis and all as well. And you have the buffer of high dividend yields from these portfolios at 5 to 6%. So I think this is pretty good. Next slide, REITs. This has been painful. I mean, again, there was a big anticipation that this is the year of recovery for REITs. And I do believe, again, like, if this tariff thing didn't hold on, we were looking at, the REITs recovering quite, prominently. Today, as the markets closed, the REIT market would have, again, bounced back to a certain level. But the macro obviously impacting the REITs market as well, and year-to-date, -7%. We obviously, our strategy did still better than the index, but it's been a painful experience when it comes to REIT investing for the broader, investor base in Singapore, myself included, over the last few years. But again, from an opportunistic standpoint, if I were to look at where the opportunity is, and if we avoid a recession and this tariff thing goes away, I will actually remain invested in REITs and wait for that bounce back to happen as well. All right, next one. I think that's it. Okay, let's go back to the questions. All right. So what is dollar cost averaging and how can we as retail investors achieve that? So essentially, dollar cost averaging, if you think about Finance 101 and, how you should be investing, your monies regularly, dollar cost averaging is an easy way to invest your money. Now, most of us are basically, employed. We have a job, we earn on a monthly basis and we spend on a monthly basis, and then we save on a monthly basis, right? What is suggested is if you earn, say, $10,000 every month, you should be saving at least $2,000 per month, right? So that's a basic, Finance 101, where you should save at least 20% of your monthly income, right? If you're doing better than that, you're already good. If you're not, then you should try to aim to save at least 20% of your monthly income. Now, most of us, what does that saving do? It sits in our bank account. But if you want your money to grow, because inflation is your enemy, right? Like, if your money just sits in the bank account, does nothing, then the value of that money keeps going down by 2 to 3% every year. And that's why you should invest. Now, the reality is on a monthly basis, you only have this $2,000 that you're saving. So at max, you are basically able to invest that $2,000, right? And you might have some other, things that you're saving for and all as well, which you want to be a bit more conservative about. But essentially, if you want to maximize your long-term goals in terms of retirement and other, such kind of like, very long-term aspirations, whether it is buying a house, whether it is a retirement, financial independence, then you need to try to maximize these savings from savings to investing. And dollar cost averaging is basically a way to do that, where instead of trying to time your entry points, you just find that every month I'm going to put, say $1,000 out of that $2,000 into the equity market, right? And every month I will, put that and move that from my bank account to an investment portfolio. And over time, what that means is, you will remain in a disciplined way invested into the market. And then as the market goes up, your investments start to go up as well. It avoids a lot of pitfalls of investing when it comes to investor biases. Psychologically, you are always geared to, let me see if the market can go down further, and then I will come and invest in the market, which most of the times doesn't pan out that well, and you end up with a lot of cash heavy, allocation within your overall, wealth perspective and all. We did have an enhanced version of dollar cost averaging. Maybe we can go and cover that one more time so that, people who did not attend it could again be reminded of how potentially, if you do want to time the market, but it's not really a market timing thing, but it's basically a better way to implement your dollar cost averaging strategy. Right. So I think like this is a perfect example. Like, first, if you just consider dollar cost averaging, what it enables you to do is if you have, a certain monthly $1,000 to invest every month, and the price of the stock or your equity, basket goes down over multiple months, because you are investing that $1,000 every month, you are buying the same security or investment at lower prices, meaning that you're getting more units of that same piece, and which means that your average investment basically, the average price of your investment is much lower than the $100 if you would have invested at one go, right? So if you think of your return over the course of these 6 months, your lump sum actually remains flat. But because you spread your investment through these 6 months, your DCA return actually is much better. Obviously, this is the specific example when the market is on the downturn. When the market is on an uptrend, then actually the lump sum investment will do better. But as I said earlier, most of us are folks who have jobs, and we earn on a monthly basis, we save on a monthly basis. So obviously, from a deployment standpoint as well, we might not always have a lump sum amount to invest in the first place. And that's why this dollar cost averaging strategy is so powerful in terms of just deploying your money very systematically into the market. If you go on to the next slide quickly, what is enhanced DCA? So it basically just builds on this traditional DCA concept. But what it does is it basically stretches you in certain months. So if the market does go down, instead of doing the same $1,000 a month, maybe you can do 1,500 for certain months, right? So it allows you to adjust your investment amount based on market conditions. But again, you're not trying to time it, from a perspective that I will look at this exactly, and when this happens, then I'll do this. You don't do it manually. It is done in a systematic manner, right? Now, this is something that we were trying to experiment with, and we said that, okay, we'll run some back tests and see that if, this strategy is employed, does it actually lead to a better outcome than even dollar cost averaging, right? And fundamentally, it should, right? Like, think about it. If the markets are falling, you're investing more, basically, again, meaning that you're buying more units at lower prices, and you're buying less units because, like, if you're buying $1,000 worth of units when the markets are, rising, but you buy 2,000 worth of stocks when the markets are going down, you're basically averaging much faster. And because this adjustment is done on a monthly contribution, you're basically buying into the dip, and you're accumulating more shares at a discount, right? At the same time, you're still remaining disciplined and systematic, and removes emotions, biases, second guessing, all of those things, etc. It's basically, a strategy that follows these specific trigger points and, deploys your money very systematically as well. So if you go on to the next slide, again, I think we did a couple of back tests so we can, see the impact of it. The traditional DCA, you would have invested 195, the same $1,000 you would have invested through these 6 months. In an enhanced DCA, you double the amount, right? Like, so in month 2, you buy $95 worth of the stock, but you double the amount. Instead of 1,000, you're buying $2,000. If it goes down further, again, you still double. If it goes down further at 80, you still, invest double. But if it comes back to 100, then basically you go back to $1,000 as well. And if you look at the return of this, if you compare it against the normal DCA, which was 9.8%, you're actually generating that 11.8%. So, enhancing your return to that, effect. So I thought like this could be a better strategy for people who do not have the time to really, track the market on a day-to-day basis. If you can actually automate your investment through an enhanced form of DCA, that actually already, then covers you from a perspective that, you're deploying more when the markets are down. So you are kind of like, able to market time without actually needing to track the market. So Interesting concept. Like, again, if you need more details around it, happy to do, a separate session or reach out to the advisory team. But I thought this was pretty interesting, so sharing that here. So let's go back to the questions. What is the outlook of Syfe's flagship REIT plus fund in the investment climate? Can we expect to see some bright spots in the coming days, weeks? If not, is it time to cash out? Look, I think people who have already been invested into the REIT portfolio, I would encourage you to remain invested and remain patient. Overall, the REITs market actually was working in the right direction. Everything kind of like checks out if you look at it from a fundamental standpoint, right? Like the occupancy rates are at all-time highs. You see the rental reversions, they are happening at the right levels. If you look at valuations, etc., again, trading at price to book values of 0.8, so historically low in terms of valuations. And again, the spread in terms of dividend yield that you're getting in comparison to the government bonds, it's more than 4%. So if govies are giving you 2.5%, the REITs are now giving you 6.5%+ in dividend yield. So look, I mean, people who have already been invested, I think your problem is that, okay, these yields are fine, but I'm losing capital, and when will I get my capital back? And the reality is, like, if you remove away all these macro impacts that we are seeing on the Singapore market as well, REITs, in my opinion, is poised for a bounce back. And even if, for example, there is an aspect of recession that might kick in, and if this tariff thing holds on and all, that has a wider global implication, not just on the REIT side, but also on the global equity market side. But we are looking at the interest rate coming down in the near future, because if the Fed does cut down the rates, that will kind of follow through in the Singapore market as well in terms of reduced interest rates. And that will be a huge kind of like boost onto the REIT side as well. And this was kind of the play that was panning out in the first quarter until it kind of again got derailed with the Trump tariffs. So again, my view is still very, very positive on the REIT sector, purely from a fundamental standpoint, purely from the local economic landscape standpoint. But if the macro picture changes, that's not something that we can control, and that can still have a negative impact on the REITs market. So if you're invested, I think it is important to remain invested. If you can, again, if you have the capacity to add more and average out your prices, I think that's a good thing potentially for you to consider. If there are people who have been on the sidelines and like the high dividend yields of the REITs right now, I think probably a good time to consider, again, in a tranche-based fashion to deploy into the REIT markets, right? Like, so that is, the two things that I would suggest. What portfolio on Syfe is recommended to invest for this market turmoil? Look, I think, again, everyone has their own investment, risk appetite, etc. If you ask me, myself, on my personal level, I, obviously deploy bulk of my money into the Syfe Equity 100 portfolio, because I'm a growth investor and I'm investing for the next 20 years. So each downturn and each, correction that has happened in the market, I've been adding money into that portfolio, right? But again, like, if you even see the Equity 100 portfolio, it has also, compared to S&P 500 and the Mag 7 stocks and all, obviously done better. But because it's still an equity portfolio, it's also, gone through a pretty decent kind of, drawdown. And if that is something that you cannot, sort of go through, we have these multi-asset portfolios such as core growth, core balanced. In core growth, there is 70% allocation to equity. There is 30% allocation to bond and gold. And essentially, you saw that, yes, I mean, bonds also came off, but they came off on a relative note much lesser. And gold also came off, by the way, considered to be a safe haven. But again, on a much, smaller basis compared to the equity markets. So if you were invested into, these more globally diversified, not just from a country standpoint, but also from an asset class standpoint, these are portfolios that I would recommend in terms of investing for the long term, and specifically if you're looking at growth. If you are very paranoid about the market, you're very uncertain, we do have the downside protected portfolio. So if you believe that actually this is just a short-term relief rally, and there is another big leg down to come, but there could be these short-term spikes, and you don't want to miss on those spikes, then the downside protected portfolio is perfect, because you're protected from the downside, but you still get to participate in the upside if that happens. And then, of course, if you are an income investor, overall, while you've seen some credit spread widening and interest rates moving up, from an entry point standpoint, it's great to again invest into the income portfolios because you are coming in when the yields are very high. And essentially, if you're looking forward, even if there is a recession, for example, the credit spread may continue to widen, but the interest rates will come down. And if the Fed does cut, then again, you're looking at the bond market to do decently well. So I would say two things, right? Like, number one, what is your objective? If you're looking to grow your money, if you ask me personally, I'm investing into the equity market, and I'm doing it in a diversified manner through the equity 100 portfolio. If your risk appetite is lower, you diversify further into bond and gold through the other core portfolios. If you are a bit more active and you want to avoid any big drawdowns, then you have the downside protected portfolio as well. This is on the growth side. But if you are more of an income investor, if you want to generate consistent dividend yield, our income portfolios gives you monthly passive income. If that is your intent, that's your goal, then that's where you start. All right, should I just go with a WU ETF or just invest into the equity core portfolio? Is the ETF in equity core portfolio balanced out risks as compared to S&P 500? This is a great question. Again, I mean, as I was just trying to cover this as well. WU is basically an ETF that invests into the S&P 500. So it's only the US market exposure. The core equity 100 portfolio is a global portfolio. It invests not just in the US market, but it also has allocation to the developed markets, to emerging markets as well. So because it is diversified beyond the US, and we had that slide, I'm not sure if you saw it, but essentially the drawdown in our core equity portfolio was much lesser compared to your S&P 500/WU ETF as well. And you look, I mean, I'm not saying that the US position in the world order is going to change anytime soon, but there is definitely questions about US, exceptionalism now being posed, and US dollar being, the reserve currency in the long term and all as well. Now, again, some of these are, I guess, a little bit of fear mongering. There is not much that is going to happen in the near term. But if you are trying to invest for the long term, it is important that you diversify beyond the US as well. And that's why my recommendation will be to invest in a globally diversified portfolio like the Syfe equity 100 core portfolio. But look, we give choices to our investors. We have our brokerage platform as well, and we have WU available in the UCITS format where it is more tax efficient and all as well. So if you want to just invest into the US market and you don't believe in the diversification argument that I was just posting, you can just buy these ETFs directly onto our brokerage platform as well. But again, then you will have to manage it. You will need to ride that through. If you want to automate it, it's a bit more tougher to automate your investment there. There is an auto invest feature, by the way, there in the brokerage platform too. But the core portfolios, we rebalance it, we keep it optimized. We constantly are looking at the market and thinking, what is the best way for this portfolio to be positioned to absorb all of these shocks and still keep you on your on track for your goals, etc. as well. So yeah, I think again, your choice. But if you ask me for a recommendation, I'll definitely recommend the Syfe Equity 100 portfolio. Are we expecting stagflation that may hurt stocks and bonds? So I think if the tariffs do hold, stagflation will be a better outcome. I mean, not saying better outcome. I mean, it would be the default outcome, if not, recession. So stagflation basically means you're seeing slower growth and you are seeing, inflation increasing. Now, usually the tariff-related inflations, again, my view is that these will be negotiated and we will come to a more, sane level of, tariffs, etc. And while, there is inflationary impact in the short term, if the sane mind minds kind of like prevail, overall, my view is that yes, there will be a short-term spike in inflation, but it will not be a persistent spike in inflation, meaning that while you might see stagflation in the near term, the more important thing is, is the growth getting impacted, right? And that will be the core determinant of how, the overall interest rates kind of move as well. Because, if growth gets impacted, if, employment takes a hit, then you're looking at the Fed cutting rates. And if the global consumption kind of gets impacted as well. So while there is inflation because of tariffs, etc., if the consumption goes down, there is demand collapse. And if there is demand collapse, then you're not looking at an inflation anyways. So my view is that right now it is the default potential outcome. If you look at how things are panning out, how the US Treasury is moving, and how the stock market is kind of behaving as well. But if the worst case pans out and these tariffs remain in place for a longer duration, we are actually looking at a recession, not a stagflation environment. And if there is a recession, then on the balance, you will be actually better off with a diversified portfolio which has stocks balanced with bonds, because the bonds will kind of like again insulate you from these bigger drawdowns, etc. Ooh, is it a good time to buy Singapore bank stocks? Look, I mean, a lot of us feel we missed out on the Singapore bank stocks, very high yields and tremendous growth over the last few years. Is it a good time? I think, like, see, the Singapore banks, have very healthy positions. They have, strong balance sheets, and they have the wherewithal to kind of like navigate through the market, uncertainties and all as well. So if you are building, for example, again, it depends a lot on what are you trying to solve for. If you're trying to solve for income, right? I think in terms of diversification, if you're only invested, for example, in Singapore REITs, it's actually a great time to diversify and add banks to that strategy, right? Because then you also, add some element of growth into your investment mix. So yeah, I mean, like, if you ask me from a diversification standpoint, as well as like, the fact that our banks are doing very, very well. And while they might be again impacted because of the macro situations, how that unfolds over the long term, but if you are building a long-term income portfolio in Singapore dollar, and if you're looking at SGD denominated securities, there are only that many options. So will I add banks to my REIT kind of exposure? 100%. What do you think? Bond yields went up. I think we covered it, so we'll skip that. Next. Do you think perhaps Trump administration is starting to reevaluate and shift away from their tariff approaches given their decision for the 90-day delay? I think, like, overall, we covered this at the start. Basically, they, like, Trump has to blink, right? Like, he was starting to see that there is, his own supporters were starting to question, and I'm sure within the administration as well, he would have had, voices which were, not aligned as well. And we were basically looking at markets kind of capitulating, right? And this is, almost it was leading to a civil revolution of sorts. We started to see protests in certain parts of the country, etc. So my view is that, like, he's blinked and he's basically, he's tried to paint it in a way where basically he's saying that, okay, we give you a 90-day reprieve. And in this time, all the countries who did not retaliate, it's your chance to kind of negotiate and come to good terms. And we will be, again, like, generous. But China, you did not comply. So we will keep, imposing those huge penalties on yourself, right? So yeah, there is a bit of re-evaluation because of the fact that, the support was kind of dwindling down, the markets were capitulating, the bond yields, which were supposed to come down, actually shot up. So everything, the game plan that they had and the pathway that it was supposed to take, the outcome that the Trump administration had anticipated, obviously did not pan out. And that's the reason why they're reevaluating this. Should we add new funds now that the market is down? I think like, again, I covered it. Each market downturn is an opportunity to add more. Now, again, it's very tough to time the market. If you would have asked me, like, again, I would have put a lot of money before yesterday, before the actual, rebound. But we have been talking about adding funds with each decline. And if you, again, go back a week, this is exactly what we were saying. So is it time to add funds? If you have cash sitting, in terms of strategy, if you ask me how I have been deploying, if I have $100 sitting in my bank account or cash, solutions, I'm looking to deploy in tranches. So I've deployed maybe 30 odd % of that money, but I'm wary of what lies ahead, and there is still a lot of uncertainties, and there is still a pretty high probability of recession, which means that there might be another leg down. So I'm keeping some cash to deploy with that in mind. What asset classes will do well moving forward, and what can we expect from the REIT Plus and the bond funds as well? I think, like, when you look at the equity markets, obviously, having a more defensive positioning will help during this environment. But, kind of like we are in a situation where essentially if it rains, all of us are going to get wet, right? Like, unless you have the umbrella, which is our downside protected portfolio. But if you don't have the downside protected portfolio, you just need to kind of like navigate through this market and live with it in a way. Because again, like, we covered this earlier, over a longer duration, you will be fine in the equity market. So within the equity markets, if you're looking to, invest, relatively speaking, you should look at the more defensive sectors, your utilities, your healthcare, and consumer staples, etc., have done relatively much better compared to your growth stocks. This is something that we have also incorporated in our equity 100 portfolio again, where we have these specific ETFs like Moat. We have a dimensional ETF called DFAT. We have which is like combines value and mid to small cap companies. But also on the Moat, it combines very good value companies, but which have very strong quality and moat as well. So these are kind of like building blocks that are already embedded in our equity strategy, which helps you again, navigate these market situations a little better than a very concentrated S&P 500, which has more than 30% exposure to the Mag 7 stocks, right? So that obviously is very tough in terms of allocation. If you were invested very concentrated, I would definitely appeal to you to kind of like diversify within the equity basket that you hold. And in terms of other asset classes, I do believe bonds will do well, and especially high quality investment grade kind of bond funds, which is what our Income Plus portfolio is composed of. REITs, I cannot say for sure. I mean, like, look, the macro environment will have a bearing on how the REIT market pans out. But if I look at it from a fundamental standpoint and local, economic standpoint, REITs, were poised for a bounce back, and hoping that this recession thing is alleviated. REITs should have a pretty high bounce back probability going forward and all as well. But as it stands, yes, the macro backdrop is not that conducive on that side. And then again, like safe haven assets such as gold, etc., always good to have in these uncertain times. It is not something for generating excess returns, but it is more to navigate these uncertain times, and having that stability where everything else is coming crashing down. You have gold as one of the elements that helps you again reduce your drawdowns in the portfolios. What does a rate cut mean for us? Look, I think near term, if there is a rate cut, which is done a bit more preemptively, I think it can help a little bit from a standpoint of more liquidity in the system, and that basically means there is more room for the economic growth aspects to continue, etc. But if the rate cut is done after we are already in a recession, and there is huge earnings gaps in the markets, etc., and all, then it can have like a negative bearing more to do with the equity markets, because it's in reaction to a recession, versus if the rate cuts are done to address potential slowdown in the economy. I think it can help in boosting the overall market in the near term. Thanks for the knowledge sharing so far. Thank you. I've been seeing the news that gold has been very resilient, doing well during this economic turmoil. Do you recommend we buy gold, and how do you do it on Syfe? I think I covered this question. So, but in terms of how to buy gold, you can do it through our brokerage platform. So, a couple of ETFs, or the most prominent ETF for gold is called GLD, which you can buy through our brokerage platform. But if you are, looking to get that exposure to gold in a more asset allocation basis, then again, our core growth, core balanced portfolios do have, that gold allocation in the portfolio already inbuilt for you. I'm just conscious of the time now. We are at 7:38. Maybe I'll take one more question and I'll stop there. And then, the rest of the questions, we are noting all of them down, and maybe over the weekend, we will collate everything and do a Q&A of sorts as well. Is this tariff situation, if this tariff situation continues, let's say 90 days later, which sectors would you think will actually excel in stock price, financial services, etc.? Look, again, I would just be positioned a bit more defensively if that were to happen. As I said, if this tariff situation persists and, in the same level that we are seeing right now, which is at 20%, right? Then I think overall the equity market, might have a tough time in the near term. So, most of the, as I said, when it rains, everyone will get wet. So everyone will, all sectors, all industries across countries will get impacted. But in relative terms, if you're defensively positioned in more, consumer staples, your healthcare, utilities, these defensive sectors on a relative basis, those will be okay. All right. I do know there are more questions. I am really sorry. I will have to go now. But I hope I have answered as many questions, more or less broadly. And if you guys do have more specific questions, just reach out to me through email, ritesh@syfe.com, to the broader advisory team, advisory@syfe.com. Again, I can see that a lot of us are going through this painful period. But again, please, I would again appeal that essentially don't give up on the markets yet. Diversify, remain invested, and dollar cost average, and maybe the enhanced dollar cost averaging if you can. Thank you so much for joining us today, and we'll keep you guys posted. And happy investing.